Hello out there. Welcome to another edition of Macro Mondays. We're back to recording on an actual Monday, but things are still a little bit special today as I'm recording from my home studio while you're in the usual Swedish sauna, Andreas. Welcome to the show.
Thanks, Mikkel. I think it's quite the thing to call your home office a studio, but anyway.
I mean, it is what it is. Anyway, Andreas, another very, very dramatic week in global macro and global markets. Huge sell-offs, a little bit of a rebound perhaps this Monday morning. And then a lot to look forward to in the coming week with the huge US presidential debate, obviously. We'll jump right into it. As always, this is a sneak peek into all the research and content you can see on at stenoresearch.com. We're going to give you a sneak peek into some of our models, which drive our thinking and our analysis. And Andreas, perhaps it's worth mentioning that we record these episodes right on top of our Monday morning investment calls. So you're getting a sneak peek into how we run our portfolios and what thinking lies behind that. So that's what you're getting here. I want to start in quite another place, Andreas. We've been talking a lot about commodities and metals over the past few months, and I saw this tweet which I really, really liked from Brendan Balo. I think you retweeted this as well. Mining stocks are the best. Whenever commodities go up, mining stocks decline by 1 to 2%. When commodities go down, they decline by 5 to 10%. Where else can you get this leverage in markets? I mean, that's I think that's a feeling both you and I have had, Andreas. Some mixed fun with these mining stocks, depending on periods.
Yeah, but this is obviously a hilarious tweet, but there's some merit to it, right? Because we've seen, for example, gold miners and junior miners delivering relatively poor returns compared to the actual commodity, and it's been a thing for a decade or so, if not even more. And I'm still of the view that if you want to invest in this commodity story, then go directly to the source instead of utilizing these miners.
Absolutely. So, Andreas, on the agenda today, we're looking at the current sell-off, what's driving it, and when could this stop? We've talked a lot about the September momentum. We'll come on into that. Then a couple of perhaps sharp questions. Is AI over? Is momentum over? We'll get back to that and have maybe a little on the sharp edge there. So, Andreas, the current sell-off. Yeah. We had quite a tough week last week in global markets. Is this explained by this chart that we've shown over the past couple of weeks? The withdrawal of liquidity during September, is that what we're seeing, or is there more to the story?
I think it's obviously a partial driver of what's ongoing, but the overwhelming conclusion is that we actually haven't really seen the liquidity withdrawal yet during September. So if the liquidity picture is the actual driver of this sell-off, we have to accept that the market is front-running the actual liquidity withdrawal that we will see over the next 3 weeks. So let me just reiterate, on September 16th, we have a corporate tax deadline upcoming in the US. And on top of that, we also see a seasonal pattern towards more non-withheld personal taxes being paid mid-September, also due to this deadline. So all in all, the point here is that we have tax seasonality to take into account when we look at liquidity right now in the US. And it will be pretty nasty. We're talking a couple of $100 billion just because of this tax seasonality. And then adding on top of that, you have the window dressing by banks towards the end of the quarter, leading to a liquidity withdrawal of up to $350 billion when you look at the averages for the past quarters. So the case here is essentially that dollar liquidity will dwindle by almost $500 billion from now and until end of month. And the backdrop is not particularly promising. And if you look at the liquidity level right now in the system, it's close to pain thresholds already. And if you remove $500 billion on top of that, it's very likely to cause some disturbance in money markets and with spillovers to other asset classes. But I'm of the view that what we've seen so far in September is essentially a result of the complete loss of momentum in China, paired with an obvious loss of momentum in the US. So that's kind of typically what we see in September. September is a bad month historically, and it is again this year. And yeah, we have 3 more weeks of this upcoming, and I think that's the sad message here. And I find it very tricky to find something upbeat to say today. And when we're talking about the very short term, we can discuss the long term in a second.
Absolutely. Let's dive into those two factors that you mentioned here. First of all, we have our macro regime model, which is based on nowcasting of growth, liquidity, and inflation from the US. All 3 indicators trending towards very, very low probability of them rising. That's essentially what you're getting on this chart. This is good when you look at inflation, obviously, but growth looking very, very low in this. And even if we have seen a slight uptick in liquidity, outlook's not too great there. So what to make of this, Andreas? Is this how certain are you of this regime model and what it shows us right now?
Well, it's a very high conviction scenario right now with all 3 parameters moving in the same direction and with very low probabilities of them rising. So I guess it's as large a conviction as you can have, and we've been very vocal around that over the past 3 weeks and made a truckload of money on it. So when you look at inflation first, with a very low probability of inflation rising here, and we're talking in year-over-year terms, it's actually a good question whether that's good or bad news, because recall the inflation report that was released in July. It essentially sparked a major sell-off in equity markets because of that direct link between the dollar versus Asian currencies and the risk-taking that we had ongoing in NASDAQ and other indices in the US. And recall that inflation report, it was very soft, and it ultimately proved to be a trigger of a sell-off. So at this juncture, if inflation keeps falling, it's not necessarily good news. That's just what I want to reiterate here. When you look at growth, I still consider this very linked to what I call tariffs front-loading. We had a major front-loading of activity ahead of the summer. We're now seeing the activity moving in the other direction. Here's a great chart on it with the Chinese exports of copper and copper products. So China simply had to front load activity to circumvent the tariffs that were implemented by both the Biden administration and also the European Union. The good question is now, I don't know whether you saw that over the weekend, but Trump started talking about tariffs again in a rally, I think in Michigan. And quote unquote, he said that we're going to put 100% tariffs on countries that dislike the dollar, something like that. So it seems like tariffs could be a very clear topic for this presidential debate as well, Mikkel. I don't know whether you have something to add on that, because I haven't really heard Kamala talk about tariffs, other than she actually said that you should consider a tariff equal to a tax, which is debatable in my opinion, but there's some merit to that viewpoint as well.
Yeah. I think she's going to be talking more about price gouging. We'll get back to that later in the show. I think definitely Trump will use tariffs as one of his main policy proposals here. I think it's been a very popular policy to take a much harder stance against China. I think he will continue upon that and maybe expand upon it. I think some of the previous ideas we heard about and sort of an overall 10% tariffs on all the imported goods, that's not going to happen. But it is a relatively, it's a very practical implementation of foreign policy and trade policy, something that people can understand. And I think that makes it a very good policy proposal and potentially something he could bring on in this debate, which we'll get back to a little later here.
But Mikkel, there's one point to make on prices out of China in relation to these tariffs. If you look at, we had the PPI numbers out of China between Sunday and Monday, and they were extremely soft once again. Also why the dollar is regaining some ground against Asian currencies as we record here. And right now with China trying to sort of gain market shares via fully owned supply chains within EVs to a certain extent within wind turbines and clearly also within solar panels, I think it's quite likely that they will have to lower their prices even more in response to a new set of tariffs, right? Because otherwise they will not be able to stand their ground in terms of market shares, and they're aiming at gaining market shares. That seems to be the strategy, right? And the PPI reflects this. I mean, it seems like prices will continue to remain soft in China. So in response to tariffs, they will keep prices low or maybe even lower them further. So that's why I kind of hold the view that sure, a tariff is some sort of tax when a good enters a country. But Trump is also right that at least parts of the bill will be taken by the opposite side.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Absolutely. I mean, it's a very understated point about China that yes, we in the West are very much dependent on China, especially for EVs, green transition, etc. But China is also very dependent on us to have a market to sell all this stuff, and that's partially what we're seeing right now. Just wanted to bring up this, as well as we're doing the regime model in the US, we're doing it on China as well. We haven't shown this too much in the show, but I think it's very, very relevant because China is a big driver of what's going on right now. So Andreas, could you just take us through how do we do this? Because we don't have as many data points as in the US. So how do we do this regime model?
Well, we have loads of data points. The question is whether we can trust them, Mikkel. But when we look at gauging Chinese growth, we aim at only using variables that are non-manipulative. So we're talking about air pollution numbers. We're talking about shipping numbers because we can essentially confirm if a ship arrives in the sort of on the other end of that trade, right? So everything that we can actually confirm with Western numbers or Western gauges of Chinese activity via satellites, that's essentially our strategy to gauge Chinese activity. And as you can see, the light blue here is the Chinese activity gauge, right? It peaked early July, so essentially exactly depicting what I said about China front-loading the activity ahead of the actual tariffs implementation. And then we've seen more or less a landslide in the Chinese activity data since early July, and it's been worsening into September. But there is a little bit of hope now. And again, I think it's kind of related because, Mikkel, let's assume that you're a decision maker, board level member or whatever in a US company, and you see another leg of tariffs likely being implemented after the election. I wouldn't rule out that we get one more set of front loading ahead of that election date. We need to watch out for that because that could ultimately change the trend in commodity space. And it's been a very, very nasty trend that we've made a lot of money on in commodity space. But if China front loads again ahead of the election date, it could be something to consider.
Yeah, absolutely. And when we talk about front loading, we might also, this is a bit unsure, we might also be seeing some effects of a front loading in anticipation of a US East Coast port strike. And we are hearing some reports that a lot of goods are being shipped in as much as you can. The limit to that is obviously the number of ship and the shipping capacity, but I think we will see a lot of that, which will essentially, as I understand it, make it harder to trust these numbers because it's a matter of seasonality almost, instead of a true gauge of sort of inherent economic activity. So very, very interesting. So just to sum up the question I posed at the start of the show. What's driving this sell-off and how is it different from the July sell-off? It seems that there are some more fundamental macro factors in play here.
Yeah.
Weak China, weakening USD liquidity. Does this make this sell-off more significant or more sticky than the July one?
Yeah, I think so. And I mean, also, if you look at it technically, it looks a bit worse this time around. We've had a double top in NASDAQ and S&P, for example, which is a technical, very bearish setup. I ultimately think that this is good news, and let me explain why. When we get to the conclusion that dollar liquidity is too tight, the Federal Reserve will respond to that by adding liquidity again. It's something that we've talked over and over about this year. When do we get to that actual pain level? Because that is something they monitor on a daily basis. If if not even in real time in the Federal Reserve System. If we get a spike in money market rates, if we get a dash for dollar cash, which I find very likely here in September, meaning that you can only hold dollars, everything else will drop in value, then the Federal Reserve will have to respond to that. And I've seen rumors already of them discussing whether to end QT at the meeting here in September, which could be a way of sugarcoating a 25 basis points cut. We had Chris Waller out on Friday after the release of the week non-farm payrolls report. And in the Q&A session, he kind of leaned towards 25 basis points here in September. That was also sort of the catalyst for the complete meltdown towards the weekend. And in my opinion, Chris Waller is a very wise guy and probably the best guy in the FOMC in terms of assessing balance sheets impacts on markets and all that. And he didn't really fully exclude the possibility of doing 25 basis points in September and ending QT. And if they end QT in September, we'll be sounding a lot more upbeat on this show in a few weeks from now.
Absolutely. Just one final point here, Andreas, before we move to some of our flavor topics. We have a big ECB meeting on Thursday announcement. Yeah. Any surprises in store there? 25 basis point cut? What are you expecting?
Yeah, they'll cut 25 basis points. And as per usual, the European Central Bank is a reactive central bank, not a proactive central bank. So they will wait and see what happens in the US and in China to take decisions from there. So I actually think it will be kind of a disappointment for markets. Euro up, euro rates up, because they won't promise anything. And it's kind of the modus operandi of the European Central Bank. And by the way, Mikkel, we haven't brought it today, but the European nowcasting model is actually looking a bit better. And the reason is, now that we have a lot of focus on the labor market, both in the US and in the UK, we can, by the way, testify on this, given that we're employers here in the outskirts of the European Union. It's very, very difficult to lay off people in Europe. So now that we see the weakness in labor markets, we're starting to see the softening in the service demand and stuff like that. It will take a whole lot longer for it to show up in Europe because decision-making is very lagged because of legislation. Short and sweet answer to
some
that.
of the major economies of Europe. Absolutely. Yeah. That's very, very true. So Andreas, I just want to skip before we round off the show. We have a couple of more topics to touch upon. I posed two further questions in my intro. You didn't seem too impressed by them, but anyway, let's get to it. Is AI over? I mean, this is more of a meme topic, but we have a couple of interesting charts to support this. So basically, you posted this, Andreas. The point here being that NVIDIA, the yellow of the golden light here, might be having issues meeting expectations on their production. What are you seeing out of NVIDIA?
So, I mean, it's noteworthy how NVIDIA has traded since the last quarterly report, right? And if you look at forward expectations, we're roughly talking about a doubling of the results in 12 months' time again for NVIDIA to live up to expectations. And I mean, if you look at the light blue area here and the dark blue colored area, we're talking about the change in billions in investments in equipment related to AI. The point here is that we've peaked from a rate of change perspective, and the NVIDIA case is priced to double year over year on a running basis. I think it's a pretty likely case long term, but from time to time, and that's the volatility around the cycle, right? You'll have issues meeting those expectations if there's a rate of change negativity in the investment pace. And it seems like this presidential election, the rollover of funding from the Inflation Reduction Act and the Chips and Science Act, if you look at investments related to those two pieces of legislation, we're also starting to sort of level off. It's not because nominally the investments are large and huge and they're still rising, but the rate of change is not as impressive as it was 3-6 months ago. And that's an issue if your business is priced to double on a running basis. So the exponential growth, I buy it, but there will be volatility around that. And currently the trend is below that exponential trend, if you know what I mean.
Also, because there's a physical element to NVIDIA's growth. Simply, they have to produce stuff and sell, and then it's a matter of how quickly they can scale this production. So I just want to bring this on. This is not our own chart. I don't know how reliable it is.
It's for Goldman, so I think it's pretty reliable.
Yeah, absolutely. But this is also of course linked to my question. We are seeing at the very least a stagnation, if not a drop, in the use of ChatGPT. This may be driven to other LLMs. I'm not quite sure about that. We haven't seen such strong numbers for them. But it is interesting to look at this AI trend, whether we're passing some sort of peak in the usage, waiting for more wide-scale implementation to keep driving also the demand for NVIDIA. So at some point, demand might also be an issue. Right now, it's more a measure of, or it's more a question of their production capability. So just some thoughts into this. We're not AI experts, but of course, extremely interesting given how AI has been such a major driver for global macro markets over the past years.
Yeah. I also like to look at electricity prices in the typical peak hours for the consumption of AI data and all that. It seems there is some real-time merit to this drop in the utility of ChatGPT and the likes. I'm not able to explain why, and I think we'll bring Raoul on the show, Raoul Pal on the show in a few weeks to have a discussion on this, because it is an interesting development. And something that we'll obviously have to address as macro people as well.
Absolutely. So, Andreas, tomorrow, the big US presidential debate. I don't know. I can't figure out if I'm excited for this or if it's going to be really, really tough to get through. I mean, some of the past debates, especially Trump v. Biden, they were really, really tough to get through at times, really, really awkward, really, essentially. So, but obviously, this is going to be a huge show, the first major face-off between Kamala and Trump. And the main topic right now, obviously, is can momentum over, and how should that spill into your investments? I think a lot of macro people are going to be looking at this debate. Right now, this is the most recent probability of winning the electoral vote. Seems like 60-40 leaning Trump here.
It's from Nate Silver, right?
Yeah, exactly. Yeah. Essentially. So this is obviously the probability. So it is still very, very tight race. A lot to be gained and lost within the campaign. Do you think you should, or how should you take hold of this in your portfolio, and how should you mirror this in your portfolio?
So I mean, we've been tracking a few portfolios designed to make returns in a Biden-Harris regime versus a Trump regime since New Year's, and it's been rather evident that some of the Trump bets lost a lot of ground after Kamala sort of gains some momentum after Biden stepped down, and I've yet to see a sort of renewed momentum in the Trump bets, and we all know that those are related to energy, for example. They're related to law and order, and similar bets in equity space. I haven't really seen that strong momentum, even if the models have started to turn in his favor again. So I think that's essentially what you should watch out for here. Energy looks extremely difficult to trade on the long side right now. Also, given what's ongoing in China, we've seen terrible returns in oil and nat gas and what have you, right? But if Trump manages to regain some momentum, I think that could be one area of the economy to look into potentially after the election. But yeah, that's kind of my thinking right now. In terms of interest rates, I don't think either candidate is against lower interest rates right now. Of course, Trump would like the Federal Reserve to postpone all interest rate cuts until after the election to create that Kamala crash that he's been talking about. I don't know whether it's fair to say that any of those two candidates have anything to do with the actual crash that we've seen both in July and here now again in September. I'm basically of the view that politics are at least they're secondary. Politics is secondary in importance to macro fundamentals and to the economy, basically. But of course, politics can impact the economy, especially when you get large shifts in the economic policy. We talked swiftly about taxing unrealized gains. Was it last week, Mikkel? And I know that the proposal from Kamala and her team that it is designed to tax unrealized gains for those that are already very wealthy. We've made similar attempts to try and tax unrealized gains in Scandinavia, for example, also in isolation on those that are very wealthy. The simple thing that happens is that people leave.
People in capital.
Yeah, they move to Switzerland or Singapore or whatever, and I mean, I cannot stress enough how bad an idea it is. It's the worst possible idea, and then we've tested it here. I mean, it was a terrible idea. I've paid a lot of unrealized gains taxes here in Denmark as well. For some fucking reason, I'm still here, but and I mean, I've had that consideration a lot of times on whether to leave because of them, and a lot of my peers, they've left.
So I think it, politically speaking, here, what I'm looking at are two major battlegrounds right now, and I'm not talking about specific states necessarily. So essentially, Harris and Trump are trying to muster their own voters to get out there. There's no real attempts at gaining votes over the middle. It's a matter of how well you mobilize your own voters. Secondarily, we're looking at a narrative struggle, which I think will be the main struggle of this debate. To dive a little more into these two, we are beginning to receive the first numbers of the Pennsylvania voter registration data from the weeks after Joe Biden pulled out of the race. This is very interesting because this shows us these are the first concrete data on how well Kamala Harris is mobilizing her own voters in key swing states, and they're looking extremely positive, especially among the Black constituency in Pennsylvania. We know there's a lot of potential. That's the chart below, especially in Pennsylvania, to get more younger voters out to vote, and that is going to be where Kamala Harris and her campaign focuses most of their energy. Right now, things are looking good, but we need to look very closely at these voter registration numbers. Obviously, that's only one part of the equation to get people to register to vote. They also need to get out there and vote. And for that, I think this is very much a meme-driven election. That's what we've seen so far. Kamala and her staff had a lot of success with a weird campaign in some circles. I know many watchers of this show will laugh at that, say, "Oh, that was a horrible campaign," but it worked in regards to mobilizing their own core. One other focus, you talked about the tax proposals. The price control on groceries, I think, is going to be a subject. I would hope, because this would actually be an interesting policy debate. And this is what I'm talking about when I talk about the narrative of this election. Kamala will try and frame this as not price control, not markup control, perhaps profit control, but more effectively just labeling this as a price gouging ban. And I think that's how she's trying to label a lot of these initiatives, because there's a feeling that she is sort of the protector of the little man against Wall Street Republicans. That's the narrative they're trying to build, and that could be quite effective in driving out voters.
But what does that even mean?
Horrible. Yeah, I'm sorry.
What does that even mean?
I mean, it sounds really, really good. Because price controls begin to sound a little bit communist, which in all fairness it is. I mean, if you set centralized federal levels for how much a banana or a pound of minced beef can cost, I mean, that is essentially price control. But a price gouging ban sounds a lot better, because there's this idea that these huge evil forces are driving up grocery prices. So I think there are some narrative strengths to this in the Kamala campaign, and that's what she's trying to do. Trump will likely try and frame the current situation in stock markets as the Kamala crash. I don't know whether that's going to stick. And then they're obviously going to talk about the border. But much more on that next week. Andreas will try and sum up what we
let me add one thing on this price control debate. I'm, in all transparency, fully against price control. It makes no sense at all from an economic standpoint. But I think there is one relevant caveat to that view, and that caveat is found within drugs and pharmaceuticals. take the example of Ozempic and Wegovy, produced out of Denmark. You guys in the US, you're paying 10, 15 times the price of Ozempic compared to what we are. And I have no clue why, because you guys are buying more of it. So why don't you negotiate a price cap on that? I mean, it is a monopoly to begin with. So you can obviously negotiate with the manufacturer. I'm honestly lost for words why you're paying 10 times the price that we are. It makes no fucking sense because, I mean, we're buying less of it. But thank you very much, America. I mean, it has made Scandinavia very wealthy. Thank you.
You had to mention that, didn't you, Andreas? Things were going so well here in Denmark, thanks to obese Americans. Anyway, that's all we had on this show. Andreas, anything left to add to the listeners and viewers?
No, I mean, for now, it seems like the dollar will regain some ground. The typical September seasonality pans out as usual, meaning that commodities will struggle while the dollar gains some ground, and NASDAQ and the likes are very vulnerable to this. So as I said, when we entered September, and as I will reiterate today, it's very tough to make money on the long side of the market this month.
Absolutely. Thanks a lot for joining. Thanks to all of you for listening. We'll be back next Monday.
Sometimes it may be good, sometimes it may be shit.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.